You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome to this week's edition of the Systematic Investor series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where we share our knowledge and sometimes painful experiences of what it's like to be a rules-based investor, and where we, at the end, do some Q&A based on your questions, as we really want this to be a listener-driven podcast. Let me start by, as usual, say good morning to you guys. Jerry, good afternoon to you. Moritz, how are you?
Good morning, both.
Hey, doing well. How are you?
Doing just fine. Is in Florida this week. So if there are some strange noises from the hotel I'm in right now, then you know the reason why. But anyways, if this is your first time you're tuning in, we just want to say welcome. We love that you're spending some of your time with us, and we'll certainly do our best to make it worthwhile. Just a quick recap again. I mean, I haven't had the chance to follow things that closely this week, but it seemed pretty busy, and of course got really busy on Friday with some quite strong US jobs numbers, lots of jobs created, overall low unemployment, of course, and rising hourly earnings. So I guess it's no big surprise that stocks are still enjoying really strong a really strong period right now, and we're again very, very close to exceeding those November 30th all-time highs in the U.S. market. Of course, you know, the European markets didn't maybe fully recover from the early part of the week, and of course Australia and those markets maybe didn't have time to react to those news, so they may catch up in the early part of this coming week. And the other thing I noticed was that in Japan, apparently the largest public pension fund is picking a bit of a fight with short sellers. They're disallowing lending shares for short selling. So I guess that's interesting. And also at the same time in Japan, there was another $120 billion stimulus package being launched. So I guess there is nothing they won't stop to or won't do to get back to those all-time highs we saw in Japan some 30 years ago. And for those of you who may not have been around back then, equity markets can actually go down for quite a long time, even though we haven't seen it in other parts of the world for quite a while. And then, of course, looking into next week, we have the first meeting in Europe of the ECB with Christine Lagarde as the new head. And of course, Thursday, British election. So could be an interesting finish to the year before the holiday sets in, actually also to this decade, we have to remember. And then the only other thing I noticed this week was, of course, that we know that I think that it took probably about 2 years or so for the Fed's balance sheet to drop about 18 or 19% from its high while it was doing the QT. And of course, now it's doing something that they won't admit is QE. So it's not QE, but I noticed that they already sort of taken back half of that. So now we're only 9% below the balance sheet high of the fall 2017. So lots of liquidity being pumped into the system again. So I guess maybe that also plays a little bit of a role in the ever expanding equity prices. So Moritz, we missed you last week, of course. So I'm excited to hear how the last couple of weeks have been for you.
Yeah, well, thank you. I think I owe you an update because I missed last week, as you said. Maybe a quick summary on November. November was good for me. I think up about 5%, a bit more than 5% even. And on the back of that, I got a bit longer again in the bonds, longer in the equities, and that wasn't the right thing to do, it seems, for the first week of December. So I didn't have a good start into December, and it wasn't just being the bonds. It was the long silver position, which I have, long gold, all of that, struggling a bit. But year to date, it's 7 or 8% up. So the hope is that it's going to be a positive year. And if that's the case, I'm all happy about it.
Yeah, definitely. I mean, of course, we are somewhat off the highs of earlier this year, but still looking like a strong year as well as on our side. I mean, this week was, of course, very much dominated by the higher equity prices. So that's where a lot of the performance came from. We had a weaker US dollar, which detracted a little bit from performance. And also, there were a few of the commodities that weren't that easy for us either. And I'm just having a quick look. Yeah, I mean, some of the grains didn't do too well, and live cattle didn't do too well for us. And then on the upside, I mean, the winner this week really was it was found in the currency sector, but it's the only currency that made money, which was the Mexican peso. The rest of the currency sector, as mentioned, the weaker dollar didn't help. Yeah, a little bit of profit here and there, but yeah, so a reasonable start to slightly down for the month, but still healthy for the year. And we'll see how the last 3 weeks plays out. Yeah, what about you, Jerry? On your side, how's everything looking up?
Yeah, just painful in the metals. That's the biggest problem I see for us was the lead and nickel and the precious metals as well. And I was just getting paranoid about counting up all the recent trades I've done. They all sort of turned into losses pretty quickly. So I guess I was happy to see some rally in bean oil and cocoa on Friday. So I know I shouldn't pay attention to those small little things, but kind of bothers me a little bit.
We're all humans after all, right?
Still human, yes.
Still human. Yeah, absolutely. Well, I mean, as our audience can hear, it wasn't not one of those most exciting weeks. Not a lot really to report on that front. So maybe it was much more exciting to be involved in the FinTwit world this week. Maybe some juicy articles or provocative quotes we can dive into and give our thoughts on that, Jerry. So I'm gonna turn it over to you.
Yeah, there was a lot here that I enjoyed. Not sure. I didn't set an all-time record for the best tweet like I have recently, but some of the stuff I kind of enjoyed. There's this one from a trend follower on Twitter. The market will move as life will move. Perfectly unpredictable and with the best laid plans going horribly awry. We can't control the market just as we can't control the future. So the winners are simply those best positioned to benefit from a future not yet seen. I keep reminding myself, about something like this, which is basically you can't predict. No one knows where the market's going. And I hope that's true. I wonder if it's true. I've said it's true. I think my trading and my strategy, the breakouts and the moving averages and the trends, they indicate that I believe that that's true. So if that's true, what's better than what we do? What can possibly be better if you can't predict? I mean, I know there's some things out there. Rentec is our go-to. And maybe some other things. But in the long run, really, is it reasonable to even think that paying attention to the prices only and following an approach, systematic approach, taking small losses, is that, should we expect anything better than that? Or shouldn't we just sort of expect that what we do is about as good as it's going to get?
Well, it's right down our alley. I've said it many times. I cannot predict anything. So I'm a complete failure at that. And because I know that, none of us can. I like the way my system, deals with those markets, with those volatile markets that, throw curveballs at us every once in a while. And like Jerry was alluding to, I haven't found a better way of positioning my portfolio for the long term than that trend following trading style. So it's exactly what we do.
I was reminded about what you just said there, and I did see the tweet as well during the week, and I was reminded about it a little bit on the way over to the US yesterday, listening to an audiobook, which was on a completely different topic. It was more about, technology, social media, etc., etc. But it reminded me about how much have changed in the last 10 to 15 years. 10, 15 years ago, we didn't have Uber. We didn't have the iPhone. There are just things that we take for granted today, and it's just part of our everyday life, but we forget that this didn't exist 10, 15 years ago. And so I think it goes to show and confirms what you just said, and that is, it is impossible to predict. What's going to be the big trends 10 or 15 years ago, or 10 or 15 years from now. Who knows? It's certainly going to be different to what it is today. So I think having a very agnostic approach to the markets, markets that are so complex in terms of how they operate, but deep down are still based on humans and human decisions, even though some of them are programmed into computers, and we allow the computers to help us with the implementation of the strategies. But deep down, things that are behavioral based, which of course a lot of the social media is as well. I mean, but there are certain things that will never change, and so as we've talked about, having strategies that are behavioral based, I just think is important. Whether it's trend following or not, it doesn't really matter. But the fact that they are rooted in behavioral and human behavior is important. And right now, I guess we're probably one of the few that can claim that. So yeah.
Another thing to say is that I think it's very important that paying attention to the trends and following a systematic approach based on trends does not really rely so much on history. Yeah, it's the history of what happened in that particular system. When you follow these rules, did it have a tendency to work? And basically, did you take small losses, and were you in gear and making money on the big trends, which is not that difficult to create an approach that you can make sure that does that. But I think we're not really relying so much on history. History is a snapshot of what has happened, and the future is going to be different. There was another quote, this will be the first decade in modern economic history since 1850 that the U.S. won't experience a single recession. So relying upon that sort of data, like, well, we always have a recession every 10 years. Every decade has recession. That's just not what we do. That is not a good way to analyze. History is not a good guide, as I've said before, except a sample size of a systematic approach that has a large sample size. That's a good guide. But what's happened in the past, valuations, none of that stuff, no one thinks that stuff can be proven to work historically. Paying attention to fundamentals and things like that. The world's going to be different. It's going to change. And yet, an approach like ours continues to be something worth using.
Yeah. But of course, as we also often mention, is that it's a difficult approach to hold, and that's probably also why. We don't really want more people to do trend following. Really, deep down, that's probably not a good thing for us. But of course, we preach that people should embrace it. So hopefully, it will happen. But most people, when they hear that, and this is what I don't understand as well, and that is, we talk about how things will always be different and how it's a good idea, we think, to have a strategy that is not predicated on stable and convergent markets and so on and so forth. But on top of that, we have all this evidence, right? We have all the evidence of track records that are real. And so what I still don't really understand is how so many people chooses to ignore the evidence. Maybe it's just because it is too hard to hold on to, but ignoring the evidence, I think, is a really stupid thing to do.
Case in point, just a week or two ago, I showed a very long-term CTA track record trading at high volatility to colleagues of mine, and that's like close to 30 years of pure trend following trading. And as you know, the chart goes from the bottom left corner to the upper right, but with lots of volatility. Now, if you step back from that, if you looked at, so there's a beamer, beaming the thing against a wall. And if you look at the chart from, 20 feet distance, then you go, definitely want to have it. That's the one thing, right? That's the only thing you want to have in your portfolio. Nothing's better. And then you have a little bit of a focus, and you say, well, there have been those drawdowns, and there have been like 30%, and there's another one at 35%, and that's been going on for 3 years, and all that type of stuff, right? And then the thing completely changes. And I think this is, I've said this before, I guess, is the difficulty is in holding on and not giving up. The end result, I'm pretty sure, is beautiful, going from point A to point B over that long period of time is great. But in between, there are so many bumps that are so easy or so likely to throw you out of the curve and have you leave, the system and step away from it. That is where the risk is. And to me, this is also where the alpha is. If you can be the guy holding on to the system during those stressful points of time.
So to add to that, Moritz, I mean, this is a long-term journey. I mean, investing for many people should be at least a 20, 30, or 40-year journey. So, I mean, so who cares about what the performance is going to be next month or even what the returns are next year? I mean, who cares if you're losing at halftime? What matters is what's the end result, right?
I know. But also statistically, I'm not sure. I mean, maybe this is a question from my side to the two of you. Statistically, what is the average holding period of your clients in your funds? So we know when I looked at the cross section of investors I had in the past, it's they say, yeah, we're going to be here for the long term, whatever long term means, 5 years and more, right? But then when you take like the median of how long do they actually stay invested, it's kind of like 3 to 4 years, and then they move on. And this could be, this is a time frame that could be very detrimental to trend following, because 3 to 4 years, the way we trade, the way I trade, doesn't necessarily allow the system to really play out its strength. It may come in the 5th, 6th, 7th, 8th year, whatever, maybe in the 9th or 10th, right? But 3 to 4 years could be a relatively flattish period. It could be up by happenstance, it could be down by happenstance, we're unlucky, but it's, I would say, not enough time for that long-term trend following trading approach that we have. And even though we make that very clear to investors at the outset, it seems that the half of them are not willing to hold on for longer than 3 to 4 years. And then they move on because maybe the grass is greener somewhere else. Maybe there's a CTA with a story that does better marketing, that, trades alternative markets or does this and that and the other thing. And they think this should be a good thing now to move over and swap things from left to right. I guess a lot of horsepower in your portfolio goes by the wayside if you have that behavior.
We would love to hear your thoughts, Jerry.
Yeah, I mean, I think I was just thinking about that, thinking the average is probably something that's not a large number, but then I think there are probably a handful, that's sort of like the trading, like 10% of the trades we make all of the money on 10% of our trades. Probably, 10% of my clients are going to be there for as long as I'll trade their money, basically, and so that's probably how it's worked for me. Is I've had a few long-term clients who understand the process, and I think if you truly understand risk in the markets and the amount of diversification we offer and the benefits of the systematic approach, then your holding period is forever. It's the only thing you would do. It doesn't really matter what the recent performance has been. I'm not going to put my money out there that certainly in a situation where I might make 8% and with a 50+ drawdown, just sitting there. If that's what it takes, then I'll pass.
Yeah, I mean, I've never done the math in terms of specifically saying what's the average holding, but I agree with Jerry that there's going to be some, and we certainly have some, who've been with us for decades, without a doubt, and they have enjoyed some really, really strong returns. And then there are people, and typically, of course, this happens during kind of a flat to down period where I think people get, some people just get bored and they move on to something else. And of course, other things can have an influence, and people may have to leave you after a much shorter period than anticipated. The problem, of course, is that a lot of investors spend or analyze decades worth of data to make the investment decision, but then they only look at 12 months or 18 months of data to make the decision to redeem, and that's a big problem. But I think this is also something that is more fundamental in our society today. Is I think one of the things we're losing in general as a race is patience. Everything has to happen, overnight. You don't see anyone nowadays building businesses without getting massive amount of funding because it has to happen so quickly, right? In the old days, you would build it slowly and it would last really long. Nowadays, you have to raise the capital before you even have a business. So almost. So I think patience is incredibly undervalued. And of course, we know in our industry, when we look at our track records, the importance, and we can see that from other investors like Warren Buffett. I mean, the importance of the long term and the compound effect of the returns is incredible. So we can give people all this evidence, but we still can't get them to really, really commit to just invest, keep it as a core part of their portfolio, and not look at it for 5, 10, 15, 20 years.
We're humans, and I think people want the fancy, the newest and the latest gadget and the newest thing. And as you were just saying, maybe people leave because they're getting bored. That is actually, I think, a very bad excuse to leave any trading system. I mean, we've heard the market wizards and all of them say, if, good trading should be really dull. If it feels real boring, then you're probably doing the right thing. If you're getting all too excited by your investments, then probably you're trading with too much heat, or there's something else going on, but, it may cloud your judgment. So having a, relatively boring thing that you can step away from and keep objectively in your portfolio, that's probably a good thing. It shouldn't be the trigger point to have that thrown out of your portfolio.
Yeah, I mean, the challenge is we can give people all the information in the world, but
Yes.
that doesn't necessarily mean that they make smarter decisions. We've seen that on so many fronts, even from when people started putting, or when food labels were put on food so they could see how healthy or unhealthy it is, but people are not making healthier choices, it would seem. So I think we have to, it's a challenge. The other thing that's a challenge I find is that it's just the amount of information, meaning that, and I'm guilty as charged. I mean, we provide a lot and a frequent information to our investors, and frankly, that's probably not the best thing for them to receive, yet that is what they would like. So we do it. But in the old days, when you had, an annual letter, okay, so you're up 5% or you're up 25%, that's probably a better level of information for most investors if they're invested, for the next 30, 40 years anyways. Why do you need to get weekly updates or monthly updates? But as I said, I'm guilty and charged. I deliver that to my clients because, that's what they would like. So we do that. But if I could change something and say, in terms of communication, I think we should probably slow everything down, and we should do everything we can to instill patience on what we do. And I think this is true about something that, if I think about how, Jerry, and I think about Don and so on and so forth. I mean, we've been around for so many years because we have been patient, because we've taken time to make the right decisions. We're not jumping from one model to another or one time frame to another, just chasing what might have worked the last few months or and so on and so forth. And I remember in right after the February 18 volatility spike, where equity sold off and CTAs lost a bit of money in a couple of weeks, and there were a lot of people who were asking, so why don't you go back and do some research to find ways to overcome these drawdowns when things like this happen? But the answer is, we wouldn't want to change anything just to overcome a 2-week correction if it doesn't help. If it's something that is detrimental to the long-term performance of the model, why would we try and remove a short-term correction if we're going to lose 3% or 4% per year in the next 40 years? It makes no sense. So,
very good. Although I do think people do that. So, but that's something that
sure,
is a problem.
Yeah, no, I don't disagree. Yeah. Of course, it happens. Yeah.
This next one, I read an article from a Matt Faber, interview on his podcast. It was pretty good, and especially when it's coming from someone who's not a technical trend-following systematic trader. Same issue. He's focusing on behavioral finance. And this gentleman says, it's so hard not to sell after it's up 100%. or 200%, 300%, 400%, or 500%. But so many of these just compound away. That's one of the founding tenets of behavioral finance. We become risk averse with gains, and we tend to sell too early. Moritz, a few minutes ago, said stressful times. And so sometimes stressful times are when we're making money. Clients, they're stressful. What are you going to do with that? Why aren't you out yet? That's enough. And he goes on to say, if daily performance is down, you feel pain. If it's up, you feel joy. But the pain outweighs the joy. If you look at prices all day, you'll become too risk averse. We have health warnings by our Bloomberg terminal that say looking at prices too much will make you too risk averse. So that's two things I don't do. I don't ever look at, I do look at prices, but I don't look at performance daily. And then I'm pretty guilty of milking these trades way longer than you probably should and getting out of them at the last possible second, when it's definitely in a downtrend, or I don't have a tendency to take profits or get too freaky when it's up 400%. I'm sort of thinking, okay, maybe we're going to go 800% here. So I think that's probably better than getting out too quickly. So we've talked about it before, but being afraid when we've got lots of profits is kind of weird.
See, it's this, but then it's also the difficulty that people have in making a fair admission that they've made a mistake by exiting that long position too early, and they're not capable, psychologically not capable, to get back in. There are so many people who have sold Apple, who have sold Amazon, who have sold Netflix at prices far, far below where they currently are. And they never came to terms with it. They never found a way back in. And they now sit there and they look back on the stock of Apple and they think like, well, if I had only held on to that thing, I would now be a multimillionaire or something like that. It's just so difficult to get back in. And also to me, this is, if I were doing this on a discretionary basis, as, I have sometimes done, in all fairness and frankness, for instance, with all that, Bitcoin trading prior to there being futures contracts where, you just play the thing and it's going up like crazy and you liquidate some of that stuff. And so the same thing goes on there. It's outside of my trend following portfolio, but, I'm guilty as everybody else. But with my system, the system doesn't have any of those regrets. And it's incredibly valuable to have it programmed in, and you need to step back from the desk. And if the thing gets you out of a market, you take a profit, it has been going high, and it then goes down, you get out, you have to be able to get back in. And this is what the system just does. And I don't even question the thing anymore. It's just the rule.
Yeah, I mean, just touching on sort of a summary of the last 2 points we talked about. I think the other challenge we have, you talk about this thing about, being active in getting out more, but never getting back in again. I mean, here's one of the other things that I think we're faced with as investors, and that is with everything in life, pretty much, except investing, there is a very high correlation with activity and effort and outcome. Meaning, if we want to get in shape, well, the more we go to the gym or et cetera, the better the result will be. But with investing, there is no correlation. In fact, it's probably opposite. The less we do, more likely than not, is the better the outcome. If we just stick with the portfolio for very, very long time, we're going to have a better result than trying to jump in and out all the time. And certainly we know from the studies on day trading, most day traders lose money every single year, and their accounts are blown up after a few years because they're just being too active. So that's just another challenge we have when dealing with these things, is that there are so many things that we are programmed to do as people, as humans, which makes us really bad investors.
Another good point that I think we've talked about before is, and we'll get into this on another tweet, another MEB interview podcast talking about risk, and this interviewee saying, have know why. What the hell is going on with this idea of risk being the amount of money that you may lose in a trade? That's crazy. Risk is fluctuation per day. So ignoring that and focusing that risk is actually your percentage of winners and 60%, and then multiply that times your average loss. And these losses are, really have to be overcome by profits, and focusing on that and not on the daily fluctuation, especially on a trade that's made 800%, or 400%, gives us this incredible power to stick with it and to be cowardly with losses, but bold with profits. And it gets to the heart and the core of what trend following is. Is it daily fluctuations, or is it a gambling idea of I'm going to limit my risk and limit how much I lose on each hand, and it's a bet, which I fully embrace. So I think that allows us, if we can force ourselves into thinking differently about the fluctuations. I'm certainly in favor of a monster trade that's made a lot of money and the ATR is 10x of what it was when you put it on, to take some off the table. You get lucky near the top, you get unlucky near the middle, whatever, but that's fine, so you can sleep at night, and so your portfolio is not so crazy. I'm not against that. It's a huge trade, and it's random as to whether it's how much you're going to make in it. But it is kind of interesting to sort of note that taking small profits on the way up, smaller than the system would indicate you would take, it can kind of fool the numbers. You can have a Sharpe ratio on that trade of infinity if you get out near the high. And if I have a trade that the max P&L is 800% profit, but I end up making 400% in it, and I look like I'm an idiot. I've had this huge monster drawdown and made a lot more than you made with your Sharpe ratio of infinity. So I think that these are all ideas that are at the root, and make trend following difficult to love. And yet it's kind of one of the reasons I do love it. It is so right to me, and so I enjoy being right in the market and being right intellectually.
Yeah, completely agree. And of course, this year is going to be one of those years where, or maybe, this is the other thing that influences to some extent, maybe the appetite for not just what we do, but just anything that diversifies away from equities. When you've had a decade that we're just coming out of now, where, anything you did in terms of diversification would have detracted from your returns of a pure stock, long-only stock portfolio. It just hasn't paid off as such to be diversified. So that's the other challenge we'll have on that. But again, when you look at the very long run, that doesn't hold up either. Diversification does work and is incredibly important, but it just doesn't work all the time.
That's right. Just have to be patient with that as well. I'm sure there will be times, again, in the future where our diversified approach will do better than a long-only S&P 500 allocation, even though the past couple of years it hasn't been the case. But we will have our place in the sun again.
Yeah. Well, I think people have forgotten that the actual total return for equities from 2000 to 2010 was minus 12%.
Yeah, completely muted. Exactly.
Completely, yeah. No return. What else did you see in your Twitter feed this week that you liked?
Well, over the past couple of weeks, there's been some articles, I guess probably mostly about equities, that talk about no need to do short trades, factor investing kept simple, forget the shorts and focus on the longs. So all of us don't agree, and I copied something from Moritz that said, yes, I would have made more money without the shorts in my trend following system, but from a risk return standpoint, I want and need the shorts in my portfolio. And I think that's what we've all experienced, that maybe the shorts haven't been that great, but they definitely make money sometime. 2014, short energy, the CTAs made a lot of money, but over the entire period, our shorts, great money makers, not yet, but they may be. Once again, are you predicting the future? If you sort of say that, I've sliced and diced, and so shorts are not great, and then go ahead and slice and dice some more. Okay, grains are not great. They're not great on the long or the short side. So now we can really narrow it down and get really precise and ignore shorts and ignore the grains. And now we really got something. Well, I don't think you really do, because you are predicting that bit of history, what has happened, rather than just describing what has happened, it's something now you can really rely upon. So you're far away from your entry-exit rules that create this sample size, and you promise to follow it going forward for the rest of your life and ignore delineating between the longs and the shorts and the different sectors in the markets. So I think that's a difference between a typical CTA and trend follower and the academic crowds that, once again, are going to focus probably mostly on stocks. And but still, I still will say that regardless of what short stocks have done, not enough sample size, they could become very, very profitable and have big long-term trends that we've never seen before, because that's what we experience in these markets, and that's what we have, and that's what we need, things we've never seen before.
So can I ask you guys a question? Do you know the difference between liking something and loving something?
No, I'm intrigued. Well, don't tell my wife. She'd like me to know the answer. But
So you like because, but you love despite, right? So in this case, you love your trend following despite the shorts, right? Despite the drawdowns and despite the volatility in returns. And I think that's it. Sure, I mean, we can like a relative value strategy because it's stable and all of that, right? But when you truly love something you do, you love it despite it having all these things that are not just, perfect.
I love my system.
What else in the goodie bag, Jerry? We got a few questions, but not that many this week. So feel free to bring up.
I have one maybe in between before Jerry goes on. There was, and maybe Jerry, you're going to mention the same thing. You've shared it with me, this paper from our friends at Transtrend. The market is not a shop. Maybe you guys have touched on it last weekend. Maybe I'll.
No, go ahead. I have not even read it, but I'm aware of it. So go ahead. I
only found time to read through it last night before going to bed, and I was really blown away. Because, sometimes you read papers and you skim through them and there's some nuggets in there and lots of things you agree with and some you don't agree with, and you kind of like put it aside. It's an average paper and you move on to the next one. And I would say for the majority of articles, this is kind of like the case. There's some, known stuff, the well-trodden path that's, kind of like repetitive and, a little bit of news. But so this one was like a close to 30-minute read. And I put it down, and I must say, I loved the complete thing. There was just not a piece in there that I didn't like or didn't agree with. And it is an interesting topic about the market microstructure and the limit order book and price insensitive market participants trading at the settle or around the close. And nobody, to my knowledge, has ever, brought that topic up in such a nice way. It's a topic which I think, when people speak about, it's easy to make it super complex so that you lose people right away within the first 5 minutes and they give up because they can't follow through with your line of thinking. But Transtrend has done a fantastic job of just explaining why those price insensitive market participants are really a disadvantage to finding, finding a price equilibrium in a fair market. A fair market should not be like a grocery store, like a shop where you just go in and you put a product out of the shelf and you pay the advertised price for it. It should be a place where a buyer and a seller can meet, put bids and offers out in an order book, and if they meet there, then we have a trade. It shouldn't be, the prices shouldn't be forced. There shouldn't be some price insensitive force behind the order book influencing it. And there's lots of gold stuff in there about the TAS orders, trade at settlement, which, by the way, I trade. And so reading this paper got me thinking about, I need to think about those TAS orders.
Can you explain a little bit more? Just so
what TAS orders are?
Yeah.
So
let's get a little bit more meat on this.
Okay, so TAS is trade at settlement, and there are certain contracts which have that order type. It allows you to trade during the day, and if you find somebody to trade with you a task contract at the price of 0, then that other party guarantees you the daily settlement price, right? So you're not going to have any slippage. So if your aim is to be filled at the daily settlement, for whatever reason you want that to be the case, but if that is your target, then for instance in crude oil, in the majority of the commodity markets, you can put a task order into the market on that day, way ahead of the settlement, the daily settlement, right? So for instance, in crude oil, daily settlement is 2 p.m. Eastern time, in WTI that is. And so you could place an order at 10 a.m. in the morning and say, I'm a limit buyer at 0. And if you get filled at 0, then you will be getting long the WTI futures contract on that day as per the exact settlement price of that day. You may get filled at minus a tick, which means you get the settlement price even better by a tick if you're buying, right? Or you may get filled a tick higher, which means you're charged the settlement price plus 1 tick. But there's also task spreads and all that type of stuff. It's a fairly liquid market, fairly large market, growing liquidity in my experience. And I'm using it because my trend following trading system using open, high, low, close / settlement prices is actually fed that settlement price, right? This is what's the input in my system. And as we've said before, you should trade what you test and test what you trade. Certain orders that I place are actually designed to trade at exactly that settlement price for whatever that's worth. It's just the way that my system operates, right? There are other order types which don't look for the settlement price, but some do.
So is the argument that it's good or bad to have these?
It's bad. He says it's bad because there's why actually is there a need? The exchange comes up with a settlement. Why are you? I mean, if you read the paper, it'll become clear. Why are you looking to be exactly at that settlement price? Insensitive to all the other prices. You should be maybe go to the market and just negotiate a price that is good for you. So anyway, I really recommend to read this paper. It got me thinking, and as I've said, I've liked every piece of it.
Well, I'll certainly try and find time to read it. The guys at Trend put out a lot of good stuff, but I'm not so sure that I necessarily think that it's a bad thing for some orders to be done at a settlement price if that's what you're targeting anyway. So the alternative is that you would have traders sitting around waiting for the settlement price to get close to, and then do all the trading around that time anyways. It doesn't stop anyone from trading, as you said, throughout the day and try and do better or worse. I don't know.
Yeah, no, that's right. Like I've said, I mean, I need to think about this a bit more. As I've said, I'm using the order type. I'm targeting the settlement. But it has been shown, or it can be shown, that there's so much money targeting the settlement, especially at the end of a quarter, at the end of the month, like, the big expiration cycles, all of that type of stuff, that you see lots of money, kind of like really insensitive at that point. They just need to get lots of money done at the settlement because that's what they're targeting, that there's a real dislocation in price in the last couple of minutes.
But isn't that different, Moritz? Isn't that different? Sorry, and again, apologize for having not read the paper, but isn't that different? So let's just say that you agree upfront that you're going to get the settlement price, So at early in the morning, you already done your trade, you're going to get the settlement price, but you don't know what that settlement price is. But the alternative is that a lot of people will have an opinion of where they would like the settlement price to be. So they're going to try and manipulate towards the end of the trading day when I don't even know how the settlement, whether it's, just a price based on a certain time of day, like the close. We know that some manipulation can take place around the close, but so I don't even know how the settlement price is calculated for all these contracts. But I think it's a problem if you start manipulating the settlement price. But if the settlement price is just kind of, okay, this is what, like you, for example, in the DAX, in the Euro, or in the Bund, I think you can get everything you need to get done in terms of volume. you can get that done on the open price. You don't have to manipulate around the open because they'll fill all your orders at the open price if you put it in ahead of time. So I don't know that it's a bad thing that people can just say, okay, we'll get that price, whatever that price is. And in our case, since we're not that concerned per se, whether we're one tick or two ticks above or below a certain price because we're long term, I think it's much more a problem if people are trying to manipulate a certain price, whether it be the open, the close, or the settlement, because that has an influence on their portfolios or their remuneration or whatever it might be.
So I guess it's not about the one tick or the two ticks. Imagine you have a market that trades at 100 10 minutes prior to the settlement, and there's really no news, nothing going on. And then only because now is the end of the quarter, and only because in a couple of minutes the settlement period is coming up, there's all of a sudden a lot of volume going into this market by market participants who are, and this is what the paper describes, price insensitive, because at that point they no longer look at the price, they just need to get the volume done no matter what the price. So the market right now trades at 100, and then it crashes down to 97, only because all that money is looking to get done at settlement. So you are a seller, you're now selling at 97. I could be that person, right? Because I used that task order. The next session opens up at 100 again, because really the fair price of that market is 100, and that settlement that was just driven by all that insensitive money pushing it down at that one instance, and it spikes back up like a rubber band. This is more than a tick. This could be, this is
oh,
real
sure.
movement.
No, I'm sorry to interrupt you here, but no, I completely agree with that. But that I think is well, then I probably misunderstood the issue, because I thought if you wanted to sell at settlement price, you wouldn't have to go in and dump all your your positions or whatever it wanted to be. I thought you had just agreed, okay, I'm going to get the settlement. Now, if people want, because that comes back to the either quote unquote manipulation, but it comes back to another thing, which I think people are, where we are often accused as CTAs or trend followers to be influencing the markets. We've talked about this many, many times, right? I think there's a much bigger problem, and that's all these robo orders that has to happen for the passive funds where, as you say, half an hour before the close of the settle, they have to get their flows done. So all of that automatic trading happens, which has nothing to do with trend following. That's just to deal with the flow. And so that's a combination of many things, but one of them being that so much money is chasing, is now being invested in passive funds, and when they see big outflows or inflows, they have to get that volume done, and that is indiscriminate buying or selling or whatever you called it.
Exactly, price
for sure,
insensitive.
and that I think is an issue. Yeah, I think that's an issue.
No, that's what I mean. So like my task order that I've described, right? So if I'm buying a task at 0 and you're on the other side of that, it forces you to trade at settlement because you're exposed, right? You kind of like need to hedge by getting that settlement price for me. So you will be trading at settlement. You will be active. My task order forces the other side, if the other side wants to hedge, to trade at settlement. So I'm forcing that liquidity into the settlement as well through my order. And it is, like I say, I want to think about it a bit more. It was only just last night, but there's some real interesting thinking in that paper, and I recommend reading it,
sure.
Especially because the settlement is used for so many things, right? Remember, the settlement is used to calculate the variation margin that we get credited or debited in our accounts. The settlement is used to value our funds the next day. So it has an impact. That price has an impact on subscriptions and redemptions and on the NAV of our funds, and at what price clients get done when they subscribe to a fund or when they redeem from a fund. So those prices they're really meaningful. And therefore, like I said, I need to mull over it a bit more and read the paper again.
Yeah, no, it sounds like an interesting topic for sure. It's something that is worth looking into. Jerry, you were very quiet.
Well, I think I have a lot to say, but I'll limit it to, I was I thought they were going to get into my favorite topic, which is this indiscriminate buying and selling that Marco at JP Morgan came up with due to vol targeting. And I think this is very detrimental to life and the trends and trend followers. And I think a lot of the trend followers are creating this drama and this chaos by immediately throwing in orders because their vol is beyond a certain target, and it creates more volatility. So I think this, they didn't get into that as much, but I think that all of this indiscriminate buying and selling or price insensitive is creating fake prices, and my orders, your orders, everyone's orders is impacting the close or the markets in general. I remember many years ago doing some research with a friend, and he said he added in a little bit for slippage to his entry price to penalize for the trying to add slippage and commissions in. But he said, I would not add more than the high of the day, for instance. And I'm like, no, you've got to add in more than the high of the day. But that was the high. I can't buy above the high. I said, if you would have been buying, it may have been a higher high. So I think we can get fooled into thinking that, our orders don't really matter. What we're doing is not having an impact on the price. And, I think it might be for sure.
Great stuff. Thanks for bringing that up, Moritz. Do you want to do more tweets? Or do you want to jump to a couple of questions we have lined up?
Yeah, let's do some questions.
Okay, cool. First question is from Dane. Dane has a question about back testing. And he writes that I've been trading for about 6 years, fairly profitable, but I would like to know the ideal look-back period or how far back should I backtest a system. I'm looking to implement a new system in case my current system goes out of sync. My current system that I have has a 3-year look-back period or 3-year back testing. So I was a little bit confused when I read that, Dane, to be honest. I can understand the 3-year look-back period, but the 3-year back testing, I'm not sure. But I think we can probably help you in any event. So, Moritz, let me start with you. If someone is trying to implement a new system, how long would you go back in time to do a back test?
So first off, I think it's the way I look at the systems. I think it would be impossible to have a 3-year look back and a 3-year back test because I require 3 years of data to have a 3-year look back. So that kind of like gets you started. You're now at T0. The first trade may now happen. So if you have a 3-year look back, the back test must be longer than 3 years. But that aside, use all the data that you can get. I think we've said this before. Find a good data provider. We've mentioned CSI on this podcast. Lots of futures data, lots of history, reasonable prices, good service, and get that data and run the back test for as long as you can. Go back to the 1980s if you want. Go back to the 70s. Use some of the grains. Like the wheat contract goes down into I think the end of the 20s or something like that. If you buy that, so very interesting, and so have all that data, and then there is really no answer as to what your optimal look back or holding period is going to be, because this is in the eye of the observer. This is really for you to come up with as a function of how much vol and how much risk do you want to have in your portfolio? How many markets do you trade? Do you have a combination of multiple systems? All of those type of things. And it may be that, you want to be on a kind of like 3-month look back or half-year look back or, 20 days look back. It just depends on what you like.
Yeah. Anything to add, Jerry?
Yeah, definitely. I think maybe he was confused on what we mean by look back. And it's, I agree with everything Moritz said. As much data as possible back to the 80s is great. And look back period is going to be fairly obvious when you sort of get into it. Not too short term, not too long term.
Yeah, and I would just add to that, Dane, don't try to look for the perfect look back period, right? It's always going to be different going forward. Maybe choose a few different ones just to to spread your dependence a little bit. But appreciate the question. Next question is from Neal, and this must be for you guys. For equity trades, do you have a minimum amount of volume a stock must trade for you to be interested in it?
That's for Jerry, I guess. He's the single stock.
The stocks.
Oh,
trader.
yeah. Sorry. I think 1 million shares. It depends on your AUM and that sort of stuff. 1 million, 2 million shares is what I look at. I don't want to get too illiquid. Some of the most liquid stocks can get fairly illiquid on big bad days. I had a big, huge winner in Target and then a big, huge loser in Dollar Tree recently. So those things can kind of got to be careful with that. I think from my point of view, it's equally as important as well to make sure that the stocks that are in your portfolio you can short easily as well. And so some stocks, like let's say, I think Tesla might be one that's really liquid, but sometimes it's been very difficult to short because, I'm not exactly sure. I look at the numbers and I say to myself, oh, it's really hard to short. I think it probably has something to do with there's a lot of people shorting it, and it's hard to find the shares to borrow to go short. So I definitely want to be able to do the longs and the shorts, just like I do in the currencies and commodities and bonds. So that I think is pretty important. Stay away from stocks in your, that you can't easily go short as well.
Yeah. Good stuff. Hopefully that was helpful, Neal. Last question is from James. James has a couple of questions, actually. Jerry and Moritz often speak of multiple entries and exits. I can see that this is true initially, however. Is it true that once a trend emerges in a particular instrument, such as all look-back systems have been triggered, that all those systems now sit on the same trailing stop loss, and therefore you'll be taken out of the entire position in one trade once that specific stop limit has been hit? So you may get in using multiple look-back periods. The question is, do you then use the same trailing stop, so to speak, or do you have different ones for each of the entries?
No, I don't. I guess it's theoretically possible. Very, very unlikely for that stop to be the same. Could be close to each other. But they do not, by design, have the same stop. There is not one universal exit across those entries. And I'd actually like it if the exits were dispersed, and if they are dispersed, and they can happen at different levels.
Yes, I agree, but I have noticed that they can bunch up. If you're using breakouts and or moving averages, I do think it's definitely possible for the different entries to all happen on the same day. And so that is a situation where your ATR stop loss could all be the same. But you could, have your different breakouts and moving average entries and space them. But if you don't manipulate it kind of to where you're going to guarantee some spacing, which can kind of be done systematically, I suppose, then even if all of your systems enter on different days at different levels, then the exits can all bunch up. The 100-day low can be the 150-day low, can be the 200-day low, can be the 300-day low, the 75-day low. They all bunch up. It can happen. So, what do you do? Trade multiple markets, but it can definitely happen. That's probably one of the reasons I like to trade crude, heating oil, and unleaded. Maybe they're all kind of correlated, highly correlated. I won't trade them all the same, the full position, but that right there can kind of say, okay, I'm in 3 different markets, but they're kind of the same, but maybe I'll get some diversification on entries and exits in that way as well, and not just say, okay, if they're all going to be 90% correlated, I'll only trade crude. Yeah, that probably will work okay, but you'll maybe be able to add some entry-exit diversification as well. But things can bunch up. I've seen that.
Yeah. James goes on with a second question. He says, when we set up systems to test, should we always take the original data as is, or if we are volatility adjusting for position size, should we adjust all the underlying data and weight accordingly to set volatility? Well, if I can just butt in here, James, from my perspective, I mean, the data is the data. I mean, I know some managers, I think, do manipulate the data a little bit. I've heard that. So I don't want to be categoric here in saying that doesn't work, but from where I sit at least, the data is the data. And then on top of that, you apply your rules, but you don't start fiddling around with the data first. That's just my view.
Yeah, I think Quantica adjusts data based on volatility, but I agree. The data is the data, then you adjust your positions based on volatility. But maybe adjusting the data for volatility as well is something that, obviously those guys are smart, and I think they do it. So they've come up with a good idea, probably.
Yeah. Anything to add on this one, Moritz? Or do you want to get stuck in the next question from James, the last one?
I like clean, pure, raw data, period.
Fair enough. Then let's hear your thoughts on this one. James writes, what are your thoughts on emerging managers in the hedge fund space, systematic or other strategies? Is it now becoming too hard to penetrate with fee pressure and cost of running a business? Or is indeed the space just becoming indexed? What a way to finish this week's show.
Well, I think it's just, there was a tweet we didn't get to this week, but it was something like, if you want to be successful, you need to be different. So I think that's the problem, is that you're not going to be different. If you're going to trend follow, there's established managers out there with billions in assets under management that institutions and people are going to gravitate towards unless you do something very different. So figure out a way to do things different.
What about you, Moritz? You meet a lot of managers.
I agree with what Jerry has just said. I do see every once in a while there are some, managers coming up with some really cool ideas in the systematic space. It's not always pure trend following. It may involve different things, but those emerging managers, they definitely deserve a look. There's, lots of talent out there, lots of good ideas, and this in our space, in our community of trading the markets and looking to generate long-term absolute returns, it never stops. There's always research that needs to be done, and that is done by clever people out there, and they will come up with new stuff that other people haven't looked at yet. And so you need to stay at top of your game and consider these people. Some of them I think are really fantastic. I agree if your idea is to build a business with a 200-day versus 50-day moving average trend following system on 40 futures markets, then maybe that ship has sailed.
Yeah, I mean, I agree with that. I mean, on one hand, we shouldn't discourage new people from entering because many things has been built in a garage and suddenly it's the world's largest company of some sort. So never discourage new talent to come in. But I also agree with Moritz. I think that the bar has gone up. I think if you're trying to promote a product that is really average in the way it's designed and the way it performs, and you want to charge the standard fees, and there's nothing unique about it, I think it's probably close to impossible to really attract any attention nowadays. So in that sense, I think it has becoming more difficult. I also think you're right in your question, James, about are things just becoming indexed. I mean, I think there is definitely a risk that most things in business, in life, etc., are getting commoditized. So I think we have to do things to continue to command attention, to command higher fees. So, but having said all of that, I will say from where I sit, the things that have been commoditized, the people who are coming out with replicated products of some sort, I think they're incredibly average, and I can't believe a lot of people will want to pay for those. To be frank, I think there is still so much more value to be had from going to an experienced manager where they have, where their interest is aligned with what you do. They have skin in the game. They've done it for a long time. I think that is still a better proposition than something that just is average. I mean, who really wants to be average? I don't think that people have, that shouldn't be your aspiration in life, and certainly not with your investments either. But it's hard. But I think there's still opportunities out there for those who really can deliver, real returns, real alpha. Those were the questions for this week. Let me just quickly run through the performance after sort of the first week of December. Now, these numbers are, as usual, always as of Thursday evening. And I think it's fair to expect that Friday was a good day. So even though these numbers might be a little bit on the downside, I think that it's not as bad when you look at the numbers Friday night. But as of Thursday, the Beta 50-day index was down 1.86 for December. Still up 5% for the year. SocGen CT index down 1.69 for December, up 5.12 this year. SocGen trend down 0.244% for December, up 7.15. The SocGen short-term traders index was down 0.65% in December so far, up 2.76, and the bridge alternatives down 2.34%. As of Thursday, up 7.03%. so far this year. What else? Anything else you want to bring up this Sunday morning?
Don't forget, I want to get back to Meb's interview with Cleno.
Yeah.
And talk about that. So it's got a lot of good stuff in there. And I particularly enjoy, number one, reading about fundamental non-trend followers and the overlap of their philosophies of how to take money out of the markets. That's fun. And then people who are trend followers but who don't maybe pay attention to the CTA trend following orthodoxy, like I think Cleno. So that's fine, and it's fun, and we can get into it. We can get him as a guest, and we'll actually have some controversy to get into. Like you and I used to get into it, Niels. That was like our ratings had never been higher when we were duking it out about something. I don't even remember what it was. But, so let's get our ratings up by having these controversial,
yes.
He's a friend and not a foe, but there's differences of opinion, and that's more fun.
Okay. No, we should definitely get Andreas on the show. That's fine. And maybe even for 2020 coming up with some more. We'll have to find something to disagree on first of all, I guess. So we'll see about that. Speaking about ratings, we always want you to share the podcast with someone that you think would be a great fit for this show. We appreciate every time we see a review, of course, but helping us build the podcast as we go into 2020 is, of course, something we will always be very grateful for. As well as your questions, if you have some, send them to info@toptradersunplugged.com. Maybe we can get a few really great ones to finish the year. We've had lots of good ones during the year, so let's have a strong finish as well. And I think that's it. So from Jerry, Moritz, and me, thanks so much for spending part of your day with us. We're grateful for your support, and we can't wait to be back with you in a week's time.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode.